Okay, this is a question that we have received a few times in the past, Alan.
Okay.
And this is from April from Illinois.
Okay.
We used to do a full segment on this, didn't we? Usually, what is Rick Edelman saying?
Yeah, that was a long time ago.
She's like, all right, well, what do you think of Rick Edelman's opinion of Roth IRAs? So, first disclosure, I'm a big fan of Rick. Al and I know Rick personally.
Yeah, we do.
That's a name drop.
If you're not in the industry, you probably don't know what we're talking about. But if you're in the industry, you go, wow,
yeah.
Those guys know Rick Edelman. That's pretty good. I know him by name. How about that?
Well,
And he
you're
knows
Big
me.
Al.
He knows me by name when he looks at my name tag
Yes.
at conferences I go to.
So, and yeah, I think there's difference of opinions in some of the planning that we do versus what his firm does.
Yeah, I would say there's probably more similarities than differences, but we do have differences.
I think our investment philosophy are almost right on.
Pretty close, yeah.
Pretty close there.
Agree.
I think when you look at Social Security benefits, strategies or claiming strategies to pension, to life insurance, all of it. But when it comes to taxes, we differ.
Yeah, I agree with that.
And here's the reason why I believe is that we are a smaller boutique registered investment advisor with CPAs on staff. We have a very strong financial planning process that monitors all the financial planning that goes through, and we spend a lot of money basically on very good talent to make sure that we provide a phenomenal product in regards to planning.
Right, which includes a huge emphasis on income taxes, which most firms don't really do, including Rick's firm.
And I think there's liability there.
Yes, there is. Yeah,
Right?
we're taking a chance.
We're not taking a chance. It's that we're giving value that most firms don't necessarily want to, because it's like, well, here, they can get tax advice from their CPA.
Right.
They can get their tax advice from their enrolled agent or whatever. They can do it on their own. We don't want to get in that business. We're in the business of helping them build their wealth through asset management.
Right.
90% of their focus is more or less investment management. You can get a financial plan for Edelman or any of these other really fine financial planning firms for maybe a couple $100. It's not a financial plan, in my opinion. It's a cash flow analysis just to see if you're on track or not. And they might run a couple Monte Carlos, and it'll take them 15 minutes to put together. And it really helps them to identify how many other assets that you have, really to see, okay, well, what can we do and how much money can we manage? And I think that's a fact with a lot of firms. And there's nothing wrong with that, because they're helping them, create a net worth statement, which is key, and then looking at, well, what do they need to do with the net worth to help them grow? And if their firm's helping them build wealth, well, God bless them. We take a little bit different stance to say, okay, well, yes, building wealth is key, but how can you also build wealth from things that you can control? And taxes, in our opinion, are a huge thing that you can control. And so the biggest emphasis that we made since day one with Peer Financial Advisors is that, all right, we want to have coordinations of different professionals, CPAs, attorneys, certified financial planners, money managers, all sitting around the same table looking at things with an objective viewpoint. And I think that's what made us one of the fastest growing financial planning firms here in the nation. So we were just discussing before the break an email that came into us from April from Illinois. She had sent us a little excerpt from, I think, Rick Edelman's. And did they change his name too? Is it now Edelman Financial Engines? Is that the official name?
That I don't know.
Okay. Sent that to us about his opinion on Roth IRAs. If you've ever listened to our show before, you probably have gathered that Al and I are pretty large fans of Roth IRAs. And so she wanted to get our opinion. And so let me read this real quick of what Edelman says about Roths, and then we can rebuttal here. From Edelman, he's like, first ask yourself, what's the goal of investing? Why put money into an IRA in the first place? Obviously, the goal is to accumulate wealth, as much wealth as you possibly can on an after-tax basis. The question then becomes, what type of IRA produces more wealth, the traditional or the Roth? The answer might surprise you, says Edelman. If you run the numbers on a spreadsheet, what isn't hard to do, you'll quickly discover the answer is neither. It's a wash. There's no difference. If you convert to a Roth, you trigger a tax immediately, but converting won't increase your wealth. So why pay a tax right now that you don't have to pay? Let's stop there, Al.
Okay.
Let's break this down. What's he talking about?
So he's saying, so you pay the tax now, and then you've got lesser to invest, right? Or you don't pay the tax, you got a higher balance, but then you pay the tax later, a higher tax. But when you do the math, all things being equal, you end up with the same net number.
So, for instance, if I had $100,000 in an IRA, and let's say I had $25,000 outside of my IRA. So I had $125,000 total.
Okay, so that's your net worth.
That's my net worth. $100,000 in an IRA, $25,000 in a brokerage account.
Got it. Okay.
And if I decided to convert that $100,000 into a Roth IRA, the Roth IRA goes in, or the $100,000 of the IRA goes into the Roth. Now I have $100,000 in a Roth.
Right.
But I have to pay tax to get the $100,000 in, and let's assume I'm in the 25% rate.
Okay.
So that cost me $25,000 in tax.
Okay.
Is that fair? Does that make sense?
It does. So you did the Roth, and so now your net worth is only $100,000 because you lost $25,000 to tax.
Correct. So
so you immediately went backwards.
I went backwards.
Yeah.
It's like, why in hell would you do this? So $125,000 is my net worth, and then if I did the Roth conversion, I have to pay the tax up front to get that money to grow tax-free.
Right.
So now I have $100,000 in the Roth.
Sure.
But let's say you go 10 years out and the money doubles. It grows at 7%.
Okay.
So now that $100,000 is worth $200,000, but it's all tax-free. That's pretty cool.
In the Roth, yeah.
In the Roth. Rick Edelman's point is this. He's like, let's say you don't do anything. You keep the $100,000 in the IRA, you keep the $25,000 in your brokerage account, and you invest them the same.
Sure.
And let's assume they get a 7% rate of return over the 10 years. And then with that, it will double.
Yeah. Okay, so that's $250,000.
So yeah, the $100,000 is now $200,000, and then the $25,000 is now $50,000.
Yeah. So so your total net worth went from $125,000 to $250,000.
So you're thinking, well, the $250,000 is a lot more money than the $200,000 in the Roth.
In the Roth, yeah.
But what are we forgetting?
Yeah, when you take the money out of the Roth, the IRA, you got to pay tax.
So if I take the $200,000 out of the IRA, what do I truly net?
Yeah, 25% tax rate, $50,000 tax. So now you end up with $200,000 net, which is the same as what you had in the Roth.
But how about that $25,000 to $50,000 though? I have to pay tax on that too, right?
If there's gain, you bet.
Well, it did gain, right?
Yeah.
25 to 50, so I got to pay a capital gains tax on that.
True.
So I think Rick's math is off a little bit too here.
Well, and plus, I mean, that's like a lab textbook case.
Yep.
There's so many other variables that make this so much better. But that's our starting point.
So he's thinking, all right, well, it's a wash. If you pay off your mortgage, do you increase your net worth?
No.
No.
Because you took one asset and reduced a liability, so you got the same net worth.
When we look at Roth conversions, that's how we look at it, is that we're paying off a mortgage. We're buying our partnership back from the IRS.
Yeah, because you got to look at your IRA as though it's not all yours, because there's a tax component when you withdraw the funds.
So there's a mortgage on the overall IRA, and so you're trying to figure out what's the best way to get rid of the mortgage or reduce the mortgage as much as you can.
Sure.
So by having money in a Roth IRA and having money in a traditional IRA, there's many more benefits than just looking at a straight line Excel spreadsheet evaluation.
Sure. Yeah, I agree with that.
Right? One of the biggest, in my opinion, is that you now have control on your distribution. How much that you pull from an IRA and then how much that you can pull from the Roth. Maybe you do a 50-50 split. Hey, I'm going to pull 50% from my IRA, 50% from my Roth IRA. That could keep me in a very low tax bracket even though I have very high cash flow.
Right. So you're managing your distributions to keep out of the higher tax brackets.
That's one. Two, there is no required minimum distribution in Roth IRAs. So that money can continue to compound for my life, spouse's life, kid's life.
Right.
Pretty good. Number three, asset location. So if I manage my affairs effectively from an asset location, I will probably have investments in my Roth IRA that have a higher expected rate of return than I would in a standard IRA, because all of the growth now is going to grow tax-free.
Yeah, so then you have your lower expected return assets in your IRA, and you end up with a lot more after-tax money.
So when I'm considering now the tax code itself of the tax reform has reduced marginal rates, 5 of the 7 marginal rates are now
lower.
Are lower.
So
and some of them by a fairly large margin.
Tax rates are cheaper right now.
So does it make sense for me to pay a cheaper rate today than wait and pay a more expensive rate in the future? That makes sense to me.
It
so
does.
That's another, I think, a win for doing Roth.
Especially right now, because very few taxpayers are subject to alternative minimum tax, which substantially increases the tax rate. Plus, we have lower rates. Then, Joe, you combine that with it's not, there's other tax planning strategies that you can do to lower your taxable income that allow you to do Roth conversions in yet a lower tax bracket. You just have to know what they are. And if you put all of these things together and you do this same mathematics, you come out much better doing the Roth IRA. I will say if Congress, our government, decides to tax Roth IRAs...
Well, let me finish what he wrote here.
Okay.
He goes, you also asserted that the Roth avoids the requirement to take distributions starting at 70.5. So I'm reading back to Rick's here.
Okay.
Can you count on that forever? Be aware that President Obama inserted language in the 2015 budget that would require distributions from Roths at age 70.5, just as with traditional IRAs. So Rick is saying, hey, you know what? You like the fact that there is no RMDs? No.
They might change that.
They're going to change it. Barack Obama tried, but he failed. But maybe Trump can do it, or whoever's next. So that's one of my fears about Roth, says Rick. The government could change the rules at any time and do it retroactively. If you won't reach age 70 for another 20 years, you'll go through 10 Congress and maybe 5 presidents. Are you sure they won't ever change the rules? Consider that Roth will hold trillions of dollars by then. Money that's currently tax-free. That's a pretty tempting target for a legislator trying to generate tax revenue. All right. So what do you think? Changing the rules on RMDs, Al?
I would say the changing the rules on a Roth to have RMDs, that could happen. But if it does happen, then that money comes out tax-free. You would have a little bit less control. But still, for all the reasons that we already mentioned, you come up with a much better in a much better place. I think the bigger concern is, will they change the whole structure and say, you know what, Social Security never used to be taxable now, and Roths are not taxable. Now Social Security is taxable. Let's make Roths taxable. And I would say that's highly unlikely for that, just because whenever they've made changes in retirement code before, they've always grandfathered the old stuff in.
You know, last comment on this is that most of the younger generation, the millennials, are putting most of their dollars into Roth IRAs. And so his argument here of saying, hey, you know, in 10, 20, 30 years from now, there'll be trillions of dollars in Roth IRAs. You don't think they're going to change it? But Rick, guess whose trillions of dollars that is? It's the people that are going to be in Congress.
And who are they supporting? The people that have all the Roth IRAs that are not going to stand for that.
They're not going to hurt themselves.